Welcome to this presentation on stock replacement strategy in option trade. I am Aninda Datta, the presenter. Here we'll cover the following aspects of stock replacement strategy. What is stock replacement strategy? The situations where stock replacement strategy could be used. Why stock replacement strategy is best route to enter option trade for first time traders. What are the advantages of stock replacement strategy? What are the limitations of stock replacement strategy? So let's get started. Now, what is stock replacement strategy? Stock replacement is a trading strategy that substitutes deep in money call options for outright purchase of shares or stocks. This strategy enables an investor to do directional trade in shares by using options. This strategy could also be extended to buying deep in money put options for short in shares. Delta of an option indicates the percentage of underlying movement captured by an option. A deep in money option involves having high delta, captures a major part of the underlying movement. So an investor can invest in the share by just paying an option premium. The investor could do a trade-off between premium and delta, and higher the premium, the higher the delta acquired. So based on risk appetite and capital availability, the investor could decide the strike price and the delta of the option purchased. Now, stock replacement is a safe strategy for new option investors, as the maximum loss is limited to the premium paid. Selling of options looks lucrative, but the potential loss could be very high. So one should not indulge in shorting options without proper delta hedging. If the investor does not have good knowledge of delta hedging, then buying options is a better choice for him. However, buying options is a long volatility strategy, as the investor earns when volatility increases and loses the time value when implied volatility is high. So this strategy could be avoided during periods of elevated implied volatility. Say the percentile implied volatility is above 70 based on historical implied volatility. As higher implied volatility means higher extrinsic value, so the loss in time value would be more on buying options on those times. As this strategy involves minimizing the theta, so minimizing the theta on long options could be done by buying more than 3 months options. Its time to expire is more than 3 months. As options lose intrinsic value over time, so long option strategy should aim to minimize the theta. Here are the two graphs showing the theta decay of both call and put options, both out of money, in money, and at the money options. In both the cases, it could be seen that the theta of in money options of both call and put options is quite high when the option time to expiry is less than 2 to 3 months. That is the green colored lines. As could be seen, the theta of in money call and put options is highest during 0.3 months to expiry, so longer period options should be preferred while buying. The advantages of stock replacement strategy. Let's examine some of the broad advantages of this strategy as compared to outright holding of the share. In case of direct stock holding, the loss from major adverse movement of the share is much more than the loss incurred from holding an option, but the maximum loss is limited to the premium paid. Moreover, a safeguard is built in option during adverse movement of the underlying share, as option value will reduce by delta, which is always less than 1, and the delta keeps reducing as the option moves towards being at the money. So the marginal loss from option keeps reducing with every $1 adverse movement of the underlying share. The money required to execute the stock replacement strategy is much less than the capital required to buy shorter share, as option premium is generally way lower than the stock price. The strategy is very suitable when a share is expected to break out in one direction but the time frame is not certain. What are the limitations of stock replacement strategy? This strategy should not be adapted when implied volatility is high and on options being near to maturity, as time value loss would be quite high in such cases. Options could be bought in lot size only, which entails quite large number of underlying securities, whereas shares could be bought in lower quantity. In many countries, the long period options market, that is 3 months or more to expiry, is not very liquid. If the underlying moves in the desired direction, then initially the delta is less than 1. So the gain is less than from the outright holding of the share. However, the delta keeps increasing as the option goes more in money, so the marginal gain moves higher. This strategy does not work in a sideways market, as this results in time value loss, whereas long short of shares directly does not involve any loss in a sideways market. So this concludes this presentation. Hope this helps the new option traders. Thanks for watching.